Good morning. I'm very happy to chair this plenary session where our featured speaker is Oleg Itshoki from Harvard University. I'm sure all of you are familiar with Oleg's work, so he doesn't need much of an introduction. I think in short, he is the author of some of the most important work in international macroeconomics in the last few years. If you want to understand some of the most important and pressing problems of today in the global economy, whether it's global imbalances, how tariffs work in a world with current account imbalances, how financial market frictions affect the operations of the international economy. There's really no better source to turn to than Oleg Itshoki for this work. He has been recognized with a number of important awards, including the John Bates Clark Medal of the American Economic Association, which is given to author of the best work in economics, who is 40 years or below, as well as being recognized as one of the most influential young economists of his generation. So I'm extremely pleased that he could join us. Unfortunately, he cannot be with us. He couldn't travel, so he's joining us from Boston, where it's an ungodly 4:30 in the morning, I believe. So thank you very much, Oleg, for doing that. He is going to speak for about 45 minutes and we'll have some room for questions. So Oleg, please.
Many thanks, Danny, for this introduction. I'm really sorry I can't be in Belgrade. I was really hoping to be there, but for personal health reasons, I had to stay in Boston. So I will have to give this talk online. This is a very suboptimal way of doing it, but I'm very pleased with this opportunity. So I shared my slides here, and I'll talk about this paper on the optimal exchange rate policy. Originally, I thought I would talk about tariffs, but my co-author Dima Muhin, he actually is in person in Belgrade, and it happens that the next session after this is on tariffs, and he'll present our most recent work on tariffs. So you're going to get actually a better version of this in his talk after this. But I have the opportunity to talk about our kind of longer term set of projects on exchange rates. And one of the more recent ones was thinking about exchange rate policy. Exchange rate policy is kind of like a very common topic, and oftentimes we sort of discuss what types of exchange rate policies countries have. But it's a little bit of a weird starting point because exchange rate is not something that's in the objective functions. So in the objective function, we think the government should directly care about inflation and the state of the business cycle, unemployment or output gap, because those things are directly linked to welfare of agents. But why would the government care about exchange rate is less clear. It's an equilibrium object, but it's not a variable that closely linked to welfare, right? It's linked indirectly, but it's not a direct proxy for welfare. And yet we oftentimes talk about exchange rate policy. It's also not an instrument. So policy instruments are monetary policy and interest rates, capital controls, FX interventions. But we oftentimes formulate policies in terms of exchange rate targets, right? And so why is that? Why would we target something that's not in welfare, but why is it so prominently part of the policy conversation? So as a starting point, it's kind of interesting how come exchange rate becomes such a pivotal variable for open economy countries. And what's interesting is we have fairly conflicting predictions of a big class of models that we typically use for policy analysis that generally suggest that floating exchange rates are optimal. And these are the trilemma models. I'll get the chance to talk about this. So models that satisfy kind of this trilemma properties, the Mundell-Fleming kind of trilemma features, they suggest that it's optimal to have floating exchange rates. While in practice, we see a big number of countries choose not to float their exchange rates and choose to either partially peg them, have managed floats, or crawling pegs, or full pegs. And it's sometimes in the literature called fear of floating, right? While a typical suggestion for policy was to float the exchange rates, many countries choose not to do it, and this is the fear of floating. So this is another reason we want to think about it. So we want to do it in a model which is consistent with the basic properties of exchange rates. So before you go to the optimal policy analysis, a big challenge in the literature is that exchange rate is quite a puzzling variable, that many of its properties are not consistent with basic models of exchange rates or classical models of exchange rates, which were the ones that were used for policy analysis. And so they led to this host of puzzles that all have names. So there is a purchasing power parity puzzle, the UIP puzzle, or uncovered interest parity, the Backus-Smith puzzle, Mizan-Rogov puzzle, and the Musa puzzle. And so I'm going to talk a little bit about them, but the idea is that you want to do the analysis of, say, optimal exchange rate policy, or for that matter, whether it's optimal to form a currency union for some countries or a block of countries, or whether it's optimal to float exchange rate by use FXI or FX interventions actively. Like, you do really want to start from a model that's consistent with the basic properties of exchange rates, right? And all these properties of exchange rate received, they're named puzzles essentially, right? And properties meaning correlations of exchange rates with macroeconomic variables. And so it turns out that Musa puzzle that I emphasized here is the one that really is a kind of entry into thinking about optimal policy, because Musa puzzle is kind of a set of facts about what happens with economies as they switch from fixed to floating exchange rates, right? And of course, the optimal exchange rate policy would be somewhere on that range between fixed and floating exchange rates, right? And sort of what's important is to have a model where exchange rate has this dual role. It plays this classical role that's always emphasized in New Keynesian literature, for example, of expenditure switching, that when exchange rate moves, it switches expenditures, and particularly if there is a devaluation, there is a switch of expenditure from foreign goods towards domestic goods. It happens either both in international and in the domestic market, or it can happen only in the domestic market in some models. But the key role of the exchange rate is that it allows for expenditure switching between foreign and domestic goods, right? But what we have to combine it with is with the second role of exchange rate, and this one is less conventional and kind of came to a center stage only more recently, is that exchange rate probably plays a crucial role for international risk sharing. And when exchange rate moves around, it perhaps create frictions in risk sharing across countries. And so if you think about the Eurozone, right, one of the big considerations was that without exchange rate volatility, once you form a currency union, you improve the situation from the perspective of international capital flows between the countries in the currency union. And this is not part of the standard kind of policy analysis tool in, say, the New Keynesian model. This is not a force that explicitly modeled typically, but yet exchange rate probably plays these two roles, and the trade-off of the exchange rate policies are exactly probably at this dimension between expenditure switching in the goods market and efficiency of capital flows in the financial market. And this is what we want to bring into the policy analysis to kind of see what then the model has to say about the optimal policy. And so our goal or our ambition here is to have this general policy analysis framework where we can think about different countries, or sort of all countries, why they make certain choices in terms of their exchange rate policies, which instruments they use towards these goals, when it's optimal to form a currency area or have a pegged exchange rate or a partial peg, a crawling peg, so that we can kind of make sense of why a lot of countries in the world kind of exhibit this fear of float. To what extent, this fear of float is actually not fear, but part of the optimal policy in the open economy. So I will start by showing you a picture that explains the Musa puzzle. So Michael Musa was working when he was writing this paper at the International Monetary Fund. And basically, his focus was on this transition from the Bretton Woods period of the pegged exchange rate. It happened, in the interval between 71 and 73. There was a switch, but like the big switch, the end of the Bretton Woods system is the beginning of 1973. And before that, it was a period of fixed exchange rates. Everybody was pegging to the dollar or fixing to the dollar, and dollar was fixed to gold. But there was no like active gold backing going on. So effectively, it was a peg to the dollar. And so here, what I plot is the real exchange rate of the dollar against the other major 7 currencies in the world. So this is the real exchange rate. If you looked at nominal exchange rate in this period, it was pretty much flat. It was not moving around. And in 73, there was the end of the fixed exchange rate system. So nominal exchange rates started to float, and nominal exchange rates, instead of being flat, they became this volatile variables. And so that was expected. That's what obviously was the big concern, that once you go to floating exchange rates, that becomes a variable that is quite volatile. But what was more surprising is if you look at the real exchange rate, which is some type of a real price or real relative price, it compares the price levels across countries, right? Or purchasing power across countries. And we don't think of it as fundamentally necessarily a volatile variable. So it changed dramatically its statistical properties. And these are really just monthly changes in that variable for the dollar versus the other 7 major countries. And instead of this fairly stable kind of normal macroeconomic variable with volatility of a couple percent a year, like output, inflation, consumption, which all have volatility of that order of magnitude, it became this highly volatile variable that looks much more like a financial variable, like a real macroeconomic variable, right? With volatility of about 10% a year, right? And like if we think about the stock market has a volatility of 16% a year, right? And so this is much closer to that than to macroeconomic variables. And this was the seminal observation of Michael Musa. So Baxter and Stockman complemented with the second observation, which in a way gives us a fuller picture, that if we look at macroeconomic variables, that surprisingly, 73, the end of the Bretton Woods system, arguably the biggest shock to economic policy in the world, right? It was not associated with any major change in the statistical properties of other macroeconomic variables. So you can look at consumption, output, inflation. You can look at like interest rates and other variables, and there was not as much of a dramatic change. So you can detect it with more sophisticated statistical models that something happens. But if you just look at the sequence of relative consumption between US and other countries, it did not observably change statistical properties. And sort of this goes in contrast with the predictions of a lot of models. When one real variable changes its statistical properties so much, you kind of expect that other real variables will do the same. Or for that matter, maybe inflation should have changed that process, but we didn't see it. And so much of the literature that followed immediately kind of focused on these 2 quadrants, as like which was the idea of the pass-through of exchange rate. Is how come is that we can have such a volatile exchange rate with such limited pass-through into macroeconomic quantities and prices and then quantities, right? Like why this feedback was not happening more strongly. And so the literature developed successful models of this limited pass-through from exchange rate into macroeconomic variables. But what we argue in our previous work with Dima is that the bigger puzzle in a way is this quadrant, and it received much less attention. And so sort of why this part is puzzling. So think about it. If there are all the shocks that are hitting nominal and real exchange rate and make it move around so much, and you go to a fixed exchange rate regime, well, you must be absorbing the shocks with the policy. Say you use monetary policy and you absorb all the shocks with monetary policy. Well, it has to make interest rates volatile if you want to absorb it. And if it makes interest rates volatile, it needs to spill over either into more volatile inflation or more volatile interest rate output gap, because you're now using monetary policy instead of smoothing the business cycle domestically. You use it to absorb the shocks that otherwise move the exchange rate. And so it must push it into either inflation or real volatility, depending on the extent of sticky prices. And yet there was no change in real volatility or monetary volatility for that matter. And this is the really big puzzle, where all that volatility went when countries were on a peg, right? And of course, there were changes that did happen. And if you look precisely, certain risk premia changed, the properties of interest rates did change, but not of the macro variables, right? And so what you want is a model. And so if you took a trilemma model, the trilemma model will strongly say that, if you did a peg, that volatility must go somewhere, right? And so, but the models that we want to work with for thinking about monetary policy need to be consistent with this kind of major observation about the monetary regime experiment that we had in the data. Is like, how come this volatility endogenously disappears when you switch to a peg? And so this is sort of the model that I want to build, and then think about the optimal policy. And the optimal policy would be, the peg would be one extreme, the float would be the other extreme, and the optimal policy might be somewhere in between, right? And this would be the figure to which I will return, which we can think about the pegs in terms of output gap volatility versus exchange rate volatility. And the question is where sort of the float takes us, right? And so I will return to this picture once I show you the model. So of course we build on a lot of work. So there is this recent work of trying to bring in sort of this financial component of exchange rates into macroeconomic analysis. Obviously, this financial component of exchange rates was acknowledged in the literature before, but it became kind of common part or a common building block of macroeconomic models just more recently. And there are papers that are thinking about exchange rate policy, and in particular, this is paper by Gita Gopinath and co-authors at the IMF, which are bringing a lot of this mechanism into already the policy analysis framework used by IMF and suggesting to countries. So by no means this is sort of purely theoretical thing. It's kind of is kind of being part of active policy advice already to countries. And so I'll try to connect and kind of explain how our paper is different from sort of existing large literature on the topic. So I'm gonna jump into the sort of the model right away. It's just a couple of slides of the model, and then I'll be able to go through results. So the way I'm gonna do it, I'll focus on a small open economy at first in isolation. I mean, small open economy that take the rest of the world as given and see what small open economy can do. If I have a little time in the end, I can talk about what happens when you have a world of multiple countries, how they should do their policy and how it changes the ideas relative to when you look at one country in isolation, well, given the rest of the world, right? And so because the goods market side is fairly standard, I'm going to actually simplify it as much as possible, the goods market side, and the focus would be on bringing in the financial side of the model. So on the goods market side, it would be just a very standard problem. There are tradable and non-tradable goods, and I will assume is that the non-tradables are produced, while the tradables are just the endowment. But the endowment is stochastic, and so you have two objectives. You want to produce non-tradables efficiently, so you don't want there to be an output gap in the production of non-tradables, and there are sticky prices which stand in the way. So you need monetary policy to actually make sure that the production side of the economy is efficient. The tradable goods you just need to risk share. So in terms of tradable goods, it's endowment, but you don't want just to consume your endowment. Since it's stochastic, you want to have as efficient of a risk sharing with the rest of the world that you can do. And sort of the question is whether these two objectives will come into conflict: the optimal production under sticky prices and the optimal risk sharing of this international tradable good of which you get an endowment, when the two come into conflict. And so from the perspective of the households, they maximize utility over consumption of these two goods and this utility of labor, and they face a budget constraint. And so to make it particularly simple, we'll assume that the tradable goods, they satisfy the low fund price. So this is the international price of tradable goods that we can normalize to 1, and we can relax that assumption later on. If you think about sort of US having a lot of inflation in dollars, what could be the consequences for optimal policies for other countries, right? And we're here thinking about all the other countries that may or may not choose to, say, peg to the dollar, right? And so when inflation in the rest of the world is absent or prices are stable, we can normalize it to 1, and then the tradable price for this economy will just fluctuate with the nominal exchange rate, right? And so again, this is a pretty big assumption, but it gives us a good first approximation to think about things, and then you want to relax this assumption. So the next big assumption that we will make is that for non-tradable goods, this is the production function, and this is not as, kind of constraining, but we will assume that prices are fully sticky, right? And so they don't adjust. And so this is kind of a limiting situation of sticky prices. What we show in the paper, it indeed arises as a limit when you write down a model with sticky prices. We have in the paper the analysis when prices are partially sticky, you have a Phillips curve, but Phillips curve gives you an extra dynamic equation, which complicates things, but qualitatively, what I will show you everything that I will say will kind of remain true under the Phillips curve and prices that adjust gradually, but it's just easier to illustrate it with prices are fully sticky. And the goal of monetary policy is to kind of relax this friction. So it's kind of the standard idea that the best monetary policy is the one that avoids the need for prices to change. And if the prices do not need to change, if the monetary policy is chosen in that way, then sticky price is not a friction anymore, or consequential friction, right? And so the first best kind of monetary policy typically relieves the need for prices to adjust and relaxes this constraint on the economy. But otherwise, if monetary policy is different, then this becomes a constraint on the economy and it's no longer optimal. So this is the goods market side of the economy. On the financial side, we adopt the segmented market view promoted by Gabex and Maggiore, but kind of becoming a tradition now in macro of thinking about segmented market models, where the households, they can trade, so home and foreign households can trade goods, but they are not connected directly by financial trade. So the households do not directly share risk between themselves. They have to go through the financial system, through intermediaries or arbitrageurs, international banks. So in order to, say, run a current account deficit to buy more than your current endowment is, you need to borrow, and you go to the financial system to do it. And you borrow in local currency here. And so, but there is no direct sharing between the households, right? But households are not the only agents in the financial markets who want to take position. There are also other financial institutions that want to take position. Say, like there are pension funds that want to save money. They manage money for their clients. They take positions, and oftentimes they want to also take. So, in order to buy goods from abroad, you need foreign currency, but you might want to save in foreign currency as well, not for reasons of buying goods. And because we don't want to spell out the specific model of how it happens, we call them noise traders, because they take asset positions that are not directly explained by the trade balance of the country, right? And these gross asset positions might be much larger. So, for example, the desire to save in dollars might be much larger than the immediate need to buy goods in the international markets. Right, and so this demand for currency can be a lot more larger and volatile than the demand for currency to immediately buy the international goods, right? And then the other agent that's in the picture is the government, which we bring in here, that can also take positions. And so this market needs to clear. So the positions between what we call noise traders, but I wouldn't interpret it literally as noise. It's of course not noise. There are fundamental reasons for this currency demand. They're just not reasons to kind of to run trade deficit or surplus. These are other reasons. This is the net foreign asset position of a country, which is a supply for currency if it's positive into the country, or demand for currency if it's negative. This is the position of the government, so FX reserves, and the government can choose to use this FX reserves. And this is the position of the intermediaries, right? And so this market needs to clear. So this is the total demand and supply in the currency market. And so intermediaries do it to maximize profits with a risk penalty. They don't want to take too much risk in doing that intermediation. So this is the model of the financial sector. So to make progress, I first need to characterize how the first best will look in this economy, and then show how, under the frictions, how does the optimal policy try to manage those frictions and get the economy as close as possible to the first best. So the first best is you just maximize the welfare subject to technology and the country budget constraint. And so the way to think about the country budget constraint is it's also a technological parameter from the perspective of the local planner. It's not necessarily the best thing that the global planner can do, but from the perspective of the local planner, the best thing that's possible is to borrow land at the world interest rate. And you cannot do better because from the perspective of the local planner, there are no other instruments that can be used, right? But at least you get access to the world interest rate R star. And so once this is the best thing you can do, well, you will do best production possible given this production function and this utility function, and best risk sharing possible given this intertemporal savings technology, right? So you will choose what fraction of your endowment to consume versus export, and the technology of like intertemporal trade is the world interest rate. And so it turns out with this utility, with log linear utility, the best thing to do is to always have unit employment. So employment should be stable and constant in this economy independently of productivity shocks. And so output and consumption of non-tradables should just track the productivity shocks in this economy. And this way you eliminate the business cycle. This way you essentially get no output gap in the economy. And in terms of risk sharing, you want the economy to be on this earlier equation, intertemporal optimality condition, with the interest rate given by the R star. And so these blue conditions, they kind of describe where you want the economy to be. Of course, now the question is what prevents the economy to be there? And we have these two frictions. One has to do with prices being sticky, and the other has to do with frictional intermediation, that the households, they cannot directly be on this constraint. They have to go through the financial sector, and financial sector will not offer them the interest star that's in parity with our star. They will have to pay a premium for borrowing. So this is what we are going to discuss next, right? And so in order to do the analysis, we define these two wedges. Wedges are the deviations relative to this first best allocation, which we denote with tilde. And so if the non-tradable consumption and hence production is not at the first best level, there is an output gap. And this is a classical object in the New Keynesian analysis. The whole point of sort of New Keynesian model is how do you do policy to eliminate this? But we now have a second target, which is about risk sharing. And the risk sharing is whenever the capital flows are different from what must have happened in the first best. So the first best predicts that there is some level of capital flow that needs to happen in the economy to support the first best consumption. So imports and exports have to be at that level and support the capital flow in the background. So if the capital flows are different than that, you have a deviation from the optimal risk sharing, and this is the risk sharing wedge, right? And so what we show in the paper, it turns out that the objective function of the government, you can approximate it to be this quadratic loss function where you minimize the quadratic loss in terms of output gap with the weight of how closed the economy is. So if the economy is very closed, gamma is 0, and this weight becomes close to 1, then you only care about the output gap. But the more open is the economy, the more you start to care about risk sharing as well. And so you have these two objectives that you're trying to minimize. And of course, if both are 0, then you're in the kind of constrained optimum allocation that the local planner can achieve. The local planner cannot do any better than this, right? What we left out of the picture, and I see now that I'm not going to be able to get to, but in the full world equilibrium, you have to think about whether our star is efficient or not. But the local planner does not, the country is small, the local planner can do nothing about our star, so that's not part of the question for the local planner. So the local planner is just trying to eliminate these two wages taking the path of the international interest rate as given. And so far, there is no trade-off. The two zeros are possible. They are budget constraint feasible. So this is the approximation to the budget constraint to this. And so putting a 0 here and a 0 here doesn't contradict any constraints, but we need to introduce the constraints on the economy. And so the first constraint, and this is a very conventional thing that comes from the goods market, is basically that the expenditure, and so remember we talked about the expenditure switching role. So basically the expenditure between tradables and non-tradables is supported by a certain relative price. If prices could adjust, well, the prices would adjust to make this price optimal, and you don't really need to think about policies, right? You would be in a very kind of neoclassical world where prices do all the work. But when prices are sticky, it turns out that this relative price is just the nominal exchange rate. So nominal exchange rate starts playing a real role. The relative price is a real object. But it just happens to be equal to nominal exchange rates when you're in a sticky price environment, right? This price cannot move, and this is just the international price in foreign currency. So in order for the relative price domestically to move and accommodate expenditure switching between tradable and non-tradable good, you really need the nominal exchange rate to move. And this is the core of the idea why the float is oftentimes optimal. And Friedman forcefully advocated the optimality of a floating exchange rate exactly for these reasons. If you let exchange rate float, it relaxes the sticky price constraint on the economy, and it can get you the expenditure right in the goods market, right? And so, but in our work, this would be only one part of the trade-off. And so what you can do with this equation, well, you can split it into efficient part when these things are efficient, and we're going to call it the first best real exchange rate, right? Like the expenditure is allocated optimally between the home and the non-tradable and the tradable good when the relative price is optimal, and we're going to call it the first best real exchange rate, or the natural real exchange rate for the economy. And so the nominal exchange rate can accommodate this adjustment in the first best real exchange rate, right? If nominal exchange rate accommodates it, you're going to get the expenditure right. But if the nominal exchange rate doesn't accommodate the movements in the natural real exchange rate, that you're going to get one or the other friction. Right now, the possibility is open for either of them to open up, but one of them has to open up. So you're either going to make the non-tradable production inefficient and have an output gap, or you're going to have a risk sharing inefficient. And the equilibrium condition in the goods market only tells you that if exchange rate does not accommodate movements in the first best real exchange rate, one or the other friction has to open up, right? So far, exchange rate can accommodate the movements in the first best real exchange rate. The question is, why would you deviate from that objective, right? And so what comes next is an equilibrium condition in the financial market. And so I don't have much time to describe it in full detail, but the idea is that these financial intermediaries, they really take positions in an optimal way to maximize their objective function. And so this is the expected return that they can make from these positions. And in order to accommodate the trades, they need to expose them to currency risk, right? If you want to accommodate a trade imbalance, for example, it requires that there is a currency imbalance and somebody absorbs it, right? So when two countries trade and there is trade deficit and they don't share the same currency, somebody needs to absorb the currency mismatch, right? And so if this is the intermediaries that need to absorb it, well, they will only do it if they're compensated with a return given the risk, right? And so this is the standard portfolio choice kind of type of equation where this is the expected return on your currency position, which is the carry trade return when you take a unit position in one currency, the dollar, and the opposite position in the other currency, the domestic currency, and this is the nominal exchange rate. And so when you do it, the mean of this is the expectation of the return that you will get, and the second moment of this is the risk. And this is sort of the inverse of the risk absorption capacity, or risk aversion. But for the financial institutions, we don't think of it as a utility parameter. We think of it as some type of a value at risk parameter that these financial institutions do not want to expose themselves to too much risk. And so they manage the expected returns relative to risk, and this is the positions that they're willing to take. And so if we work through the equilibrium, what you get from this is that, well, remember this was the blue part, which was the optimal piece. So you want the economy to be on this earlier equation with the international interest rate. But financial intermediaries will not offer the interest rate by parity with the R-star to domestic households, because then they would not be compensated for the risk that they're taking. So they will actually charge a premium. And as a result, the households will not be on this blue Euler equation. They will end up on this kind of frictional Euler equation where this is the risk premium, right? And so this is the unit price of risk. So per unit position that intermediaries take, this would be the risk premium. And this is the size of the position that intermediaries need to take in equilibrium. And so it's the product of this kind of unit price of risk times the size of the position. So you can think of this as sort of the capital flows. This is the capital flow coming from household. This is the capital flow coming from the rest of the financial system. And this is the part that's undone by the government with their FX policies. And to clear the market, this is the position that needs to be taken by the intermediary. And together with volatile exchange rate, it would result in a risk premium and the deviation sort of from the efficient risk sharing. So this risk premium is also called the UIP deviation sometimes, right? Uncovered interest rate premium deviations, that interest rates between home and foreign are not, currencies are not in parity, and that's the risk sharing wedge. So we develop an approximation method that we can, work tractably with this model. I don't have to talk about technical details at all, but if you do that approximation, this is the equation that you get. So now remember, this was the Srish-Sharon wedge, or the deviation from the blue earlier equation. And so now the dynamics of the Srish-Sharon wedge, well, it's driven by that risk premium that we just discussed. And so this is unit risk premium, and this is the size of the position that needs to be taken, and sigma is the volatility of exchange rate. And so already here, you see the trade-off. So on one hand, you want exchange rate to allow expenditure switching in the goods market, but that makes exchange rate volatile. The second moment of exchange rate is sort of non-trivial for that reason, because exchange rate needs to adjust. But as soon as you have volatility of the exchange rate here, all the capital flows start creating frictional deviations from optimal risk sharing. So it's this inherent trade-off that you want movements in exchange rate from the perspective of efficiency in the goods market, but the more movements there are in exchange rate, the less efficient becomes the financial market and the risk sharing, right? And sort of the measure of this risk sharing condition is sort of this abstract thing, but it turns out it can be measured by frictional deviations from uncovered interest rate parity. A sort of deviation from interest rates being in parity with each other between home and the world economy. And so these are the frictional deviations. So now what's worse is that once you have this exchange rate volatility, this sort of non-fundamental, non-macroeconomic shocks, it's the shocks like desire for some financial institutions to hold dollars. Those shocks start to feed in back themselves into this risk-sharing wedge. So it's just not just the macroeconomic shock that drive the first best real exchange rate, but it's also these financial shocks that in the first best should not be part of macroeconomic dynamics, but they start to matter because they also need to be intermediated by the financial sector. And financial sector starts to charge larger premia when it's exposed to the financial shocks as well, not just the macroeconomic shocks. And so this is this inherent property which creates this interesting trade-off. So what we do, we write down the optimal policy problem. So now this is the objective that we discussed. We put an additional constraint on FX policy. And so you can think of it that like the balance sheet of the central bank is just not costless to expand the balance sheet. This is kind of the situation that we saw in Switzerland, that in principle there was a big demand for Swiss franc, but the central bank didn't want to expand the balance sheet unboundedly, even if it were making money from this, right? And so this could be a cost on the balance sheet of the central bank. Alternatively, for a lot of developing countries, the situation is opposite. They oftentimes do not have enough FX reserves to do it, and so if you cannot go into negative territory in terms of FX reserves, this function will penalize you from going into a negative territory, right? So it's not about the welfare; it's about what's feasible in terms of the FX position. And so this is the budget constraint of a country. This is the financial market equilibrium condition that we just discussed, and this is the goods market equilibrium. And so now, once you have both of these constraints, the policy problem becomes non-trivial. So I only have 10 minutes left, so instead of doing the full analytical analysis, I'll show you all the results in a picture, right? And so actually the picture turns out that summarizes the properties of the optimal policies fairly accurately. So this is the output gap volatility, the volatility of X. And this is the volatility of exchange rate. And exchange rate has all these components now, right? And so the standard trilemma models, what they say is that the financial market is efficient. So if you take a standard, going back to Mundell Fleming all the way to the New Keynesian literature based on Obstfeld and Rogoff, this part of the economy was efficient. It was a zero here. And so risk sharing is efficient. And so as a result, Z is not part of the analysis. Risk sharing is efficient. You really just worry about the output gap, right? And so then you have the simple trade-off. Like if Z is not part of the picture, you have a simple trade-off, right? If you fix the exchange rate, well, you will create output gap that moves around with the real exchange rate. Why? Because prices are sticky. And so if nominal exchange rate doesn't accommodate it, well, the expenditure switching is not going to be efficient, and it will translate into output gap on the domestic economy. And so you'll end up here where there would be more volatility of the output gap, but you'll be able to have zero volatility of the exchange rate, and that peg is feasible, but it's not desirable. The desirable thing is to let the exchange rate adjust, accommodate the movements in the first best real exchange rate so that the relative prices are right, expenditure is right, so you achieve the efficient expenditure switching, and then it would be consistent with no output gap. So this situation would be consistent with no macroeconomic distortion, and indeed it's the first best thing you can do is to be here, and that's what we call the Friedman float. That's what Friedman advocated in 57, is that the float in exchange rate is sort of essential part of macroeconomic policy in the open economy because it allows you to be here. Nominal exchange rate ends up being volatile, but we have no problem with nominal exchange rate volatility, right? It's not part of our objective to make nominal exchange rate stable per se. And that volatility is actually a useful one. It sustains the optimal allocation in the goods market. And so the trade-off for policy, this is the trilemma trade-off. Well, you can be somewhere on this line. That's why it's called, trilemma. As long as the capital flows are efficient, you have this trade-off between fixing the exchange rate or having independent monetary policy. So you can fix exchange rate here, but then monetary policy is not doing a job. Or you can have independent monetary policy do its job in terms of output gap, but then you have to have a float, right? And there is no problem to a float here. So, it's a trilemma constraint, but it has a trivial resolution, just float your exchange rate. And that's been the kind of proposal of, the theory as long as we were analyzing this trilemma models. There is an interesting point, which is a divine coincidence in the open economy, right? So it's very familiar, the divine coincidence in the closed economy when there is no trade-off between inflation and output gap stabilization. But in an open economy, there is an additional dimension, and it happens where magically, this is not supposed to be something that we expect, but if magically the first best real exchange rate is very stable, then this triangle collapses to this point. And there is no trade-off between pegging the exchange rate and having efficiency in the goods market. Why? Because you happen to be in an economy where the first best real exchange rate is stable. So you can achieve your purposes with a stable nominal exchange rate as well. If you peg it at the right level, you're just going to get things right. And this is the case for the optimal currency area in the literature, the Mundell argument, when the shocks are correlated. And sort of the metric here of highly correlated shocks between countries is that the real exchange rate between them is not volatile, then the peg or common currency area are optimal. So now what happens in our model differently to this is that this is no longer, this trilemma frontier is actually no longer the frontier along which you can choose policy. You actually have to choose policy along this frontier. So when you peg, this point is still feasible. This point was never optimal, but it remains feasible. Why it remains feasible? Well, because financial markets are efficient when there is no exchange rate volatility. When you shut down exchange rate volatility fully, financial intermediaries actually don't have to take risk. And so because they don't have to take risk, they will do efficient intermediation. And that's kind of what we saw happen in Europe, right? Like the adoption of a common currency really increased capital flows and converged the interest rates, right? So the interest rate parity started to hold much better between Spain and Germany. Perhaps one can make an argument that it held too good and was not reflecting risks. But that frictional deviation in interest rates disappeared, right? And this is sort of the mechanism of the peg. You make financial intermediation more efficient until it becomes less efficient because it maybe ignores the risks, right? But not associated with the currency, the other types of risks, which we don't focus on. But there are no currency risks anymore. And so financial market is efficient, but the goods market is not efficient. And this point is feasible. What's different in our model is that this point is not feasible because as soon as you move away from the peg, financial intermediation, this coefficient here, it's a function of sigma, and this coefficient stops being 0. And so any shocks in the financial market now, not just the goods market shocks that make things inefficient, but all these financial shocks that arguably cause the bigger part of the volatility in exchange rates, they start preventing the optimality of risk sharing. And so as a result, the float only puts you here, right? You can float the exchange rate, you can eliminate the output gap in the non-tradable market, but all of this volatility will be frictional volatility. Like this is the fundamental part of the volatility that you want to accommodate fundamental macroeconomic shocks, and that's where you would like to be, but that's not part of your choice. When you float the exchange rate, this is your choice, where perhaps arguably a bigger component of exchange rate volatility is frictional, and as a result, the risk sharing between countries is not optimal. And so you have to live along this frontier now, right? And so what the policy can do? Well, the policy can do two things. The policy would like to lean against these financial shocks with FX interventions as much as possible. What it does, it reduces the threat region. So FX intervention, subject to constraint on FX interventions, are to lean against the financial shocks and kind of eliminate the effect of the financial shocks on the risk premium, right? Like eliminate the frictional part of the risk premium in this market. And you want to do it as much as possible given the constraint on FXI. If your FXI are not constrained, you can get all the way to this point, right? And so this is consistent now with the prescriptions of the integrated policy framework at the IMF as the active use of FXI to eliminate this sort of financial volatility. But most countries cannot do FXI in an unconstrained way. And so this is really the focus. So while sort of a lot of frameworks now agree on where the first best is, what's new in our paper is the second best looks to be in a very different place. And the reason for this is that what's different in our framework is that this degree of this financial intermediation depends endogenously on the exchange rate volatility. And so when you don't have FXI, when you cannot do the first best, what you would be doing is you would be using monetary policy to lean against the exchange rate shocks, right? So this is typically what the policy does not prescribe to do. It doesn't, like the typical models would, even the ones that allow for financial shocks would say that you don't compromise monetary policy to lean against exchange rate surprises. What happens when you endogenize this risk-sharing frictions is it becomes optimal to use monetary policy, and you need a credible monetary policy with commitment where you credibly lean against exchange rate surprises. Because what happens then is that the financial market expects you to eliminate part of exchange rate shocks, and it improves the intermediation in the financial market. And so basically what happens with the managed float is that the situation where given your objective function, that quadratic loss function that has this, this point is not feasible. You'd like to be there, but if you don't have unlimited FX interventions, you can't be there. So once you exhausted your ability to use FX intervention, you start using monetary policy to lean against exchange rate surprises. And you're not going here generically, and you're not going here generically. Generically, you choose a point on this frontier. And so what's interesting, and I'll have to stop soon because I'm running out of time. What's interesting is this policy is not a constant lean. So what we characterize in the paper is you're not doing a constant lean against exchange rate surprises. So there are periods when financial markets work efficiently and risk premium are not very large. And then you ignore the exchange rate and you do the monetary policy. You are kind of in the free float for a period of time when financial markets are stable. But when you enter the period of financial market volatility and risk premium spike, the currency premium spike, this is the period when the market should expect that the government will lean against those shocks with monetary policy and eliminate part of it. In doing it, what's the trade-off? Well, the trade-off is you compromise the domestic objective, the objective of output gap. But the benefit of it is that you stabilize the financial market and you result in smaller currency premium, right? And so, yes, so I mean, obviously it has equations behind it, which I don't have time to show you, but let me show you kind of how it looks when we numerically solve the model. So this is this lean. It can be parameterized by delta, how much you compromise your output gap to lean against exchange rate surprises. You let, this is what I was going to say. You let the exchange rate adjust on average, but you just promise to eliminate the big exchange rate surprises. And so this looks like a crawling peg or moving band, which a lot of countries are using. They let the mean adjustment exchange rate. The goal is not to target a level of exchange rate. The goal is to eliminate the big surprises that destabilize the financial currency market. And so this is the monetary policy lean. And this is your FXI lean against the shocks. And if FXI are constrained, you cannot fully eliminate this, and then you have to use the monetary policy lean. And so when we solve the model, basically this is how it looks like. So when financial markets are fairly stable, this financial volatility is not very large. This is your monetary policy rule. You ignore the exchange rate. In your, Taylor rule ignores the exchange rate, puts no weight on it, and you use FXI locally. When the shocks are small, you have enough FXI to absorb them, you use FXI to absorb the shock. But as shock become big and volatility in the financial market becomes big, FXI, you just cannot use FXI. You'll burn through FXI too quickly, potentially, if you use it. And then what you do, you start switching into exchange rate management using monetary policy. And so it's like the state contingent rule to which you need to commit that like once financial market goes into a volatile regime, you have to switch your monetary policy, well, not switch, but kind of have this lean in your monetary policy rule against the exchange rate to eliminate part of the exchange rate volatility. And so it only works if you can adopt this rule credibly and the financial market believes that you're using that rule, right? It cannot be a discretionary lean against exchange rate surprises. It has to be an established reputational lean against exchange rate surprises when financial volatility is large. And sort of a lot of countries, this kind of sort of describes what a lot of countries are doing, and we can use this framework to think why different countries in the world adopt different mix of policies. So for example, why US and Eurozone have fully floating exchange rates? Well, because they have such a deep financial market that FX interventions will not go very far in moving the exchange rate in these deep financial markets, and adopting a fully floating exchange rate is optimal. But things do start to change when you think about smaller countries that are more open, that have more volatile financial flows. And for those countries, it would be generically optimal to have, either some degree of actually a currency union or peg or full peg, or a partial monetary peg and active FX interventions. And in fact, the majority of countries in the world do that. And sort of that's what in the literature tradition is called the fear of floating. But now we start to understand that it's not the fear, it's actually part of the optimal toolkit. I'll stop here and take some questions. I took more time than I should have, but let leave it at this.
Thank you, Oleg. This is a very, very rich framework, and thanks for rushing through at the end, just to leave a little bit of time for questions. I'm looking around. There are people still thinking about their question. I might ask you a question. So in your framework, essentially there are these two targets that governments are pursuing. One is the domestic output stabilization target, and the other is the risk sharing. And each has a distortion associated with that: financial market frictions in the second case, and the Keynesian friction, the fixed prices in the first. Now, I hesitate to ask you to extend your model, but I think it relates to some of your previous work as well. It seems to me that many governments now also care about the traded goods sector, that they care in some sense about the output of tradables, whether it's just for whatever reason, employment reasons, manufacturing, the industrialization kind of worries, or because there are genuine externalities with respect to the production of tradables. I mean, that's a secondary issue. And I'm wondering how that might affect some of these. First, just one way to test my intuition of my understanding is to ask you this question. Suppose you have this version of your model where there are other countries, but some countries in the world actually, instead of the risk-sharing objective, they care about the tradables objective of increasing their tradables output, which would tend to push them on balance towards higher surpluses. It seems to me that would ameliorate the risk-sharing inefficiency in the rest of the world, because then they would have access to savings from those countries, would tend to lower the rate at which they can borrow closer to our star. Is that intuition right? First, and secondly, how would the model work when there are this objective associated with tradables in general?
Right. No, thanks a lot. This is actually two big questions that require two separate answers. And I want to apologize again, not being present in person, which I really wish I could be, but this is this suboptimal way of answering questions. So it turns out we do try to attempt both in the paper. The reason we ignored the tradable production is because that's where the New Keynesian literature did a lot of progress, and the trade-offs arise exactly there for the New Keynesian literature once you endogenize the tradable production, which is already do no answers to those questions. And so it turns out this, once you model that, you have to think in which currency the prices are sticky for the tradable good, and this big literature on like PCP versus LCP versus DCP address that. You also bring in the terms of trade externality, which now the big topic of tariffs is exactly about what the countries are doing with the terms of trade externality. But this is a topic that we typically want to shut down in macroeconomic analysis because we don't think that terms of trade externality drives monetary policy in the open economy, but maybe not. And maybe we have to revise all this. So it just turns out that literature is well developed, and we can do that extension in this paper. The model becomes more complicated, but it sort of nests into the same framework. So that's why I wanted to show you ignoring the terms of trade considerations and kind of production with sticky prices in the tradable sector. But it all can be done. It largely recovers the result that already existed in the New Keynesian literature. And so oftentimes the float is still optimal. Even when you bring in all of those dimensions, it's no longer, of course, best allocation, but oftentimes there is nothing that the planner can do about it and still should choose a float, right? And so in that sense, it qualitatively doesn't change our analysis. The second question is very interesting, and kind of we do a first stab at it. So it turns out when you put a lot of countries together that pursue such policies, indeed, our star is endogenous. And indeed, now, these individual local shocks, if they're correlated across countries, say demand for dollars, which can happen in a very correlated way across many countries, especially in crisis periods, right? It's this increase in demand for dollar in the financial sector that happens in many regions of the world simultaneously. It will not only affect the allocations in the individual countries themselves, but it will start pushing against the R star. And the R star then no longer reflects the macroeconomic forces. It starts reflecting the financial forces as well. And so this is where the cooperation between countries is very important. And so what we try to do is do the first steps at like what would be a cooperative policy in this world. What I talked about was non-cooperative policies of one country alone, but the cooperative policies will demand that countries manage their reserve policies jointly, right? And so we talk a little bit about the paper, but I think this is where further research would be highly useful.
Okay. I think we have maybe time just for one more question. Yes, please.
The post-Bretton Woods period is mostly one of a US dollar world where everybody more or less trades on equal terms, but that world is pretty much disappearing. So we have trade blocs, countries prefer to trade with some countries, friendshoring, prefer not to trade with others. Can that be fitted into the model?
Yes, this is very interesting. So I should have mentioned the model is done in this dollar-centric world, but dollar has many functions, right, as a currency. And so the one that this model emphasizes is the dollar as the funding currency. So essentially that the world financial system works in dollars, right? And so the way I think about it is that the dollar will probably be losing its roles over time, but at different pace in different areas, right? So, for example, in which currency the goods are denominated when they're traded might switch much quicker. And we saw with the adoption of euro, a lot more international trade regionally started being in euros. The safe assets might move around the world. So like the US dollar bonds might no longer be safe assets. But the question here is in which currency the funding happens, the international financial system works. And so that role of the dollar might last longer. And so this is at the core of the model, where this international intermediaries, where they finance themselves and which currency they finance themselves. And that tells you that when they will look at the risk, they will look at the risk of taking a currency position against the dollar, right? So of course, once things change, you will potentially be funding in different currencies. And so then the question would be, is it going to be a portfolio choice, or it would be a segmented world where part of the world funds in dollars, part of the world funds in euros, part of the world funds in yuan. And then if it's the segmented world, then the peg would be towards the currency in which you finance yourself. right? Alternative situations, there are many funding currencies, and maybe this would be actually a more efficient world where it's no longer UIP deviations relative to dollar that matters, but it's like kind of a portfolio of currencies. We didn't do that. It's kind of super interesting. Right now, we focused on dollar as being the principal funding currency, and all the analysis relies on that. But extending it as possible, we just haven't thought about it yet. It's super interesting. Yeah.
Thank you, Oleg. I think we're going to now release you so you can go back to sleep, and we will take a little break here. But please join me in thanking Oleg Itsokhi for another very great presentation.
Thank you very much.